a panel discussion on passives versus actives, where we will find out whether passives are relevant in the Indian context. Also, will they replace actives or serve a different need? And to moderate this session, may I please invite on stage Mr. Prem Khatri, founder and CEO, Cafemutual. Let's welcome him once again with a huge, huge round of applause. I would now like to invite our panelists on stage, please. Well, he is a business leader with 3 decades of experience in financial services industry. He is a recipient of Alumni Award 2022 from his alma mater, SP Jain Institute of Management and Research in the Corporate Excellence category. Well, he is presently the Managing Director, NSE Indices Limited and NSE Data and Analytics Limited. He is a wholly owned subsidiary of National Stock Exchange of India, India's largest stock exchange. He has a master's degree in management studies from SP Jain Institute of Management and Research, Mumbai, and bachelor's degree in electrical and electronics engineering from BITS, Pilani. Please put your hands together for Mr. Mukesh Agarwal. Well, our next panelist is the MD and CEO of HDFC Asset Management Company. He joined the firm in February 2021. He has 29 years of rich experience in financial markets. Prior to joining HDFC AMC, he was the Executive Director and Chief Investment Officer of SBI Funds Management. He has a master's degree in accountancy and business statistics and is a qualified chartered accountant. Well, he is a charter holder of the CFA Institute and CAIA Institute. He has also done financial risk management. Please welcome on stage Mr. Navneet Munot. Let's welcome him with a huge round of applause. Well, our next panelist is the Chief Executive Officer of Union AMC. He is a BTech PGDM from IIM Ahmedabad and a veteran in the mutual fund industry. Well, during his impressive professional career of more than 30 years, he has worked with IDFC Investors Advisors Limited as the Chief Marketing Officer, UTI as Senior Vice President, and UTI International Limited as Director and CEO. Please welcome Mr. G. Pradeepkumar. Well, our next panelist is the CEO of HSBC Mutual Fund. Well, he leads the functioning of key business verticals and is responsible for providing leadership towards the achievement of the organization's strategic goals to become one of the top leaders in the asset management space. He has 32 years of work experience, of which 27 years has been in various functions of businesses across BFSI. Well, he was a member of the SEBI Mutual Fund Advisory Committee and was on the AMFI board. He also headed the Financial Literacy Committee for AMFI in the past. He is a management graduate from the Institute of Management Development and Research. Well, he loves to travel the world and is passionate about adventure sports. Please welcome Mr. Kailash Kulkarni. Over to you, sir.
Okay, so any topic, any event related to passives conference cannot do without discussing the perennial topic, which is actives versus passives. And we want to find out whether these two product categories, are they complementary or are they substitutes? So let me start by asking Navneet, this question because you seem to have launched a lot of index funds, and I believe you are in the process of launching many more.
Yeah, so we have launched how many? 26 passive funds in last 2 years. But that's not out of compulsion that active funds won't do well, so that's why we need to have more passive funds. It's out of conviction that the Indian asset management market is so underpenetrated. To be a one-stop solution to meet the needs of every investor and distributor, you need to have the full product range. So on active side, we have the full product range. On passive side, we have put the full product range. And of course, we have launched products on PMS and alternatives as well. I think the title active versus passive, India hasn't reached a stage where we need to discuss that. It has to be active and passive, and in capital letters, active and passive. So we have a long way to go in active in India. And even if you look at US, so much before BlackRock or some of the other passive managers who become much larger now, Battery March, Wells Fargo, so many of those asset managers in 70s launched passive funds based on the whole Chicago school theory that markets are efficient, active managers cannot outperform over a long period of time. Since then, passive funds have grown so much. But a Capital or a Fidelity also grown from 10, 20, $30 billion of AUM to managing $2, $3, or $4 trillion of management. So both of them have grown. I think in India, it will be a very, very similar journey. I've been, in fact, 2 years back in your conference, I mentioned that I'm extremely positive on future of active management in India. Not only in India, in fact, globally, we can discuss that separately. And in last 2 years, we have seen, I think exactly 2 years back, where people were looking at different time periods and different categories that active managers haven't generated alpha. That's why I think investors should look more at the passive funds and look at the alpha of, let's say, our funds in last 2 years. I mean, they are anywhere between 2-3% to as high as even 14-15%, whether in balanced advantage fund, focus fund, flexi cap fund, small cap, and alpha of like double digit in 2 years' time. And even going back longer term, 10, 15, 20, 25 years, there's a lot of alpha. But in a market where all said and done, we still have 3.75 crore unique investors, and we have to reach out to many more investors, need to have all products. And a lot of investors are yet to meet the market. They may not like to beat the market. For them, you need passive. But I think I'm sure a lot of investors would have aspiration to beat the market, and for them, we would have the active funds as well. So I think there is tremendous potential for both to coexist and grow. I'll take half a minute more. So let's say, just to an analogy, I don't know whether it's the correct analogy, but options volumes in India have grown like manifold. There's been an exponential rise in the options volumes in India, while the cash markets haven't grown so much. Can we have a debate, cash market versus the options market? How will options market grow if cash is not there? Who sets the price? It's the active funds who will always set the price. The passive funds will ride on them, and they will copy the price. But active funds have to be there to ensure that markets are there, and passive will be there to ride on that. So there is tremendous growth potential for both of them. And now, in fact, in last 2 years, we have seen significant growth even on the fixed income side, with debt index fund from nothing to almost now 13% of the overall debt AUM, and active AUM, of course, from 8% 5 years back to now almost 19% of equity AUM is in passive. Of course, large part of that might be due to EPF and pension fund, etc. But still, it's growing. Yeah. So both will grow.
And to the newly minted CEO, okay, what are your plans? How would you be looking at actives and passives going ahead?
So I think I'm going to go more with what Navneet said, and I agree with him. I think the most important thing is that we have to understand that where we are in the evolution cycle of mutual funds in India. And if we look at that, we are actually at the nascent stage, even today. We may be 3 decades old, but the true growth on mutual funds has just happened in the last few years. So when you look at that, and the fact that in India, we all love to get more money. Okay, so we are chasing returns. Active, I think, is going to be very clearly a driver. Now, within passives, will passives grow? The answer is yes. Is passives required? The answer is yes. So nobody's challenging that. But if we divide the current passive universe into government-led business, and you can say quasi-government-led business, because when EPFO comes in, there are a whole host of PFs who come in just riding on EPFO as if it's a self-certified. How many genuine individual investors are participating in today the ETF segment? And are the bid offer spreads which are there so fine that we are able to do because of the volumes are huge? I think those are challenges. So today, if I have to look at passives, I'll say I look at passives like asset allocation. We talk about maybe should a person have 10 to 20% of his wallet share in passives? Yeah? If we are very convinced that India is going to grow over the next 3, 5, 10 years, and everybody has said that we'll be the fourth largest, third largest economy in the next few years to come, there is a huge alpha which is surely going to happen in India. So it's going to be a balance between people wanting returns, alpha, and also people wanting some amount of steadiness in passives. One way to look at passives and how to enter is also because of the huge volatility. There are a lot of investors who are not willing to take that volatility. There are many days where you see the index drop 1.5% on a day. On that day, you should move your money into an index fund. As simple as that. Some money. So you keep adding into a passive and let that grow. At the same time, you can play your active. So small portion as of now for the next few years, before which really will become more relevant.
Okay, got it. Pradeep, are you looking at what is your fund house's philosophy towards this active and passives fund?
Thanks, Prem. At Union Mutual Fund, we have not launched any passive fund so far. But that doesn't mean that we don't like passive funds. Personally, I have invested in passive funds. And I fully agree with what Navneet and Kailash was saying, that, this whole thing about passive versus active is not being, presented properly. In the sense that it's like asking, are bikes better or scooters better? Or are bikes better or cars better? I mean, they're all required, for different purposes, for different people, what they should have. So it is not like, passive is good for everybody or active is good for everybody. So I think, in a market like India, we have demonstrated, and at Union AMC, we have done the research also. And we have demonstrated that, if you take on a rolling return basis, active funds majority of the active funds in most of the categories have generated alpha. Our market is still not, a perfect market. There is scope for generating alpha. There is no doubt about it. And there are enough fund managers in the market who have consistently done that. And I also have this issue that, people present that passives are cheaper and hence they are better. I think that is a dangerous reason for which to buy a passive fund. Like, if people started buying, whatever is cheaper in the market, I think that is really a dangerous trend. You should buy if that is, it has a place in your overall portfolio, right? If as part of asset allocation, 10%, 15%, 20%, if somebody wants to allocate to passive fund, by all means, it's good. And as distributors, I think, you should be willing to recommend passive funds to your clients, even if they are not very remunerative, because if you do the right thing for the investors, the overall wallet share will definitely increase. But at the same time, I think we also should be mindful of falling into this trap where we think that, passives are the only thing that is required. It's God's gift to mankind and all. I don't believe in that. In fact, an over-dependence on passive funds, I think, can make our capital markets highly inefficient. Imagine, if bulk of the money in the capital markets were going only to the top 100 companies, how will the rest of the market develop? How will, smaller companies raise money in the market? Who will allocate capital to them? So I think, it's very important for the efficiency of the capital market also to have both active and passive. And I think, only if active funds are there, you see the value of passive funds. Without that, if only passive funds were there, it would be a disastrous situation. So I think you should really look at, passives as an important part of the allocation. At Union Mutual Fund, why we haven't done it is that, in our stage of evolution as an AMC, we are focusing first on our core strengths. Passives is a different line of business. Right now, we have limited bandwidth, so we don't have the bandwidth to get into passives. At some stage, we may.
Okay, Mukesh, as someone watching from the sidelines, very closely actually, what do you feel about this debate? It is spurious.
Prem, he's creating those sidelines. He's not sitting on the sidelines.
I'm not sitting on the side. I work with the side people. So no, I think before I move forward, before coming for the conference, because nowadays everyone is talking about Chat GPT and all, I put this question to Chat GPT and then read out the answer what it gave. And it gave a very good answer actually. So it said, I will not read the whole thing. In summary, passive funds and active funds are not substitutes or complements of each other, but rather two different approaches to investing that cater to different types of investors with different objectives and risk tolerance levels. The choice between passive and active investing depends on individual preferences and investment goals. I think it summarizes the whole thing.
So you know what Prem will do next time is he will write to Chat GPT. I have to ask a question in my panel which Mukesh won't get an answer on your Chat GPT.
No. And fortunately, Chat GPT actually has competition also. So I will not just go to Chat GPT, I'll go to all the other variants also. Anyway.
No, I think coming to it, I think as others have said, both the active and passive both have to live together. They need to coexist. If you look at global industry is such a large industry. Global passive size is almost $10 trillion, but still passive accounts for 15% of the total AUM. Still the number is very low. If you look at in India, I think 5 years back the number was 3.8%. Today, March numbers, if you look at the passive share is around 17%. So both have to exist. Both will continue, as I read out also earlier. It depends on the risk profiling of the investors. And also what it has been seen globally, actually, the asset classes in which there is inefficient trading or inefficient information, those will be dominated by the active, and wherein the trading is very efficient, information efficient, those will be dominated by the passives. If you look at in India also, passive also, the size is approximately 6.75 lakh crores, and within that, debt and equity is around 6.5. But majority of the assets are in two indices, Nifty 50 and Sensex 30, which are the large caps, I think. And increasingly, what we have also seen that in the large cap funds, generating that alpha is becoming difficult. And if you look at 10 years back, if the alpha that aggregate large cap funds were generating was 2%, 3%, that alpha has been decreasing. It's not that the funds are not outperforming. There will be some funds which will be outperforming, some will be underperforming, but that alpha has been shrinking. So I think increasingly, depending on which asset class you are in, that debate, active versus passive, will become more relevant. I think that's what my views would be.
The Chat GPT answer alluded to suitability of these funds to different people. So in what circumstances do you think one category suits the investor more and and vice versa?
So basically, if I'm happy with the market returns and I want to invest at a low cost, I'm not greedy, I don't want to increment higher return, then I think I should go for passive. But if I believe, and there are a lot of investors who believe that, and we do have the fund managers who have the abilities of generating that alpha over the index, and I'm willing to pay a premium for that, then I should go for the active fund. That's what I would say.
But what would you tell a distributor on when to select a passive fund and when to select an active fund, irrespective of whether the investor is happy or not happy with his existing portfolio?
I think that depends on each distributor and then the each investor. I think if you look at India, bulk of the money on the passive side, as Kailash rightly mentioned, is from pension funds. And then, of course, there are a few categories which have grown. So for a distributor, if he's allocating a certain part to, let's say, global markets, they think that international diversification is needed. There, I think a passive would be better. You're just feeding into an S&P or a whatever, a developed world index or an emerging market index, so on and so forth. I think on the bond side, I think we have seen certain passive products, target maturity fund, etc. They can be looked at. A lot of the active investors who invest in equity market are regularly very active on their investing. They can find trading or whatever, investing through the ETFs, quite easy. But for most of the other investors, I think a large part of the portfolio, as I said earlier, strongly believe in the power of generating alpha in India on the active fund side should be there. But there could be maybe a certain part of the core portfolio where let's say certain categories that you want to play, or a satellite. I mean, you are playing a certain factor or a certain theme or a certain, let's say, somebody's allocating certain money to a banking fund or an IT or healthcare or something. I think an index fund would be better, because if it's a tactical call, you don't know that in next 1 year or 2 year or 3 year within that segment who will or will not generate the alpha. So there are, both in the core side as well as on the satellite side. And you have to look at the overall cost. A lot of time people that passive is more cost efficient, but that's not right. You have to look at in totality. When you are looking at the return of an active fund, you are looking at a total return index, and you are looking at like post fees and everything. It's just so transparent in India. On the passive side, if you're buying, let's say, an ETF, or I mean, whether on the equity side or on the bond side, you have to look at the total cost that you are looking at, paying the brokerage and the transaction cost, the demat cost, and also the difference between the NAV and the traded price. And we have seen, our team tracks it every day. There is huge difference between what gets traded in the exchange versus the underlying NAV. You have to look at it in totality. On a lighter or as well as serious note, there is a saying that there are active funds that outperform, but there are all passive funds underperform.
Okay.
So,
Underperform the underlying index.
so if you ask me what question should or what should the distributor say?
Yeah. When should he select?
Yeah,
When
so-
should he recommend active funds, and when should he recommend?
So today we have 3.7 crores, 37 million customers in the industry, unique.
Yeah.
This number will go to 100 million over the next few years. I'm pretty confident. Now, with so many new customers coming into the industry, if you pitch to them the basic index funds, low cost, plus generally a person understands index, on the equity side. So they should not ask too many questions if the index really goes up and down. They know that it's mirroring the index, plus it's relatively cheaper. So it's a great entry product for people to come, especially if you're targeting new investors. Earlier, if you remember when, passives were not there, we used to talk about get them into large cap or get them into hybrids. So this is one way of saying, so when you're pitching as a distributor, get them into products which will be easier to explain. Index fund is very easy to explain, and it will relatively light on the pocket. I think that's one entry point for them. The second, if you want to ride volatility, like I said, ride volatility by switching, on those days into index, because again, that's good for the long term for you. So I think these are two things that possibly distributors can look at. On the fixed income side, can they get more into, today the target maturity funds are more HNI oriented. So if you want to bring it down one level to the MHNI, can they then start selling this as a quasi, when you look at the YTM, you come to know, okay, this is the likely return you're expecting over this period of time. So that's something that can be spoken about, because what's important is today, the equity wallet share for any individual is very low. Whereas the equity plus fixed income, and fixed income includes bank, it includes postal, it includes PPF, it includes various other products, is pretty large. So if you don't sell fixed income or don't sell index funds, both on the equity and fixed income side, your ability to grow your wallet share from individual customers is going to remain low. So you need to use these funds to target in enhancing wallet share from each individual customer.
In last 3 years, the number of folios on the passive side have gone up from 30 lakhs to 2.1 crore. 30 lakhs to 2.1 crore, that's 1.8 crore. In last 3 years, the total folio growth in the industry is 5.5 crores, which means every third folio has got added on the passive side. So, and that's across index and bond index and all the products. So there is a huge growth that has happened even on the retail side, on the individual side. If you look at the index funds, which is 50,000 crores or so, I mean, large number, part of that is individual investors, apart from the PFs and all that who invest. So number of investors have increased very substantially. You look at the AMFI data that comes on the SIPs from T30 and the B30, and this was one category, index fund, the passive side, where there was very big difference. It was substantially higher in T30 and substantially lower in B30. But the trend has changed completely. Now there's substantially higher participation even from B30 on index funds as well.
No, in fact,
So the awareness has clearly increased substantially. And
just to add on to what Navneet and Kailash have said, just to share some numbers. So if you look at ETFs, in ETFs, participation of retail and HNI is around 9%, wherein if you look at index funds, the participation of HNI and retail is around 50%. So and that's a good thing, because ETF is not easy for retail investors to buy, because ultimately when one buys the ETF, one has to look at you're buying closer to the live INAV or live NAV, etc. And they don't understand, and a lot of retail investors don't have the trading account. So good thing is retail investors are more actively participating in the index funds, which they account for almost 50% of the AUM of the index funds.
But isn't that scary?
So the demat accounts going from 4 crores in March 20 to now 11.8 crores or so. That 7.8 crore newer accounts, a lot of them have also participated in ETFs.
No, but
so the ETF, I think the unique investors in ETF have gone up like, I mean, the base is so small that there's no point talking about multiple.
Okay. But isn't it scary that 1.8 crore people invested in products which are very low margin for you? In fact, last evening, we looked at the data of inflows for the month of April. And Navneet, one thing we found was that the inflows in passives last month was more than the inflows in actives. So if you keep getting inflows...
Not at all. No, and all of us, I mean, again, we'll repeat the same thing. We have 3.75 crore investors over a long period of time. We have to go to substantially higher number. And at HDFC AMC, I mean, our mission is to be the wealth creator for every Indian. I repeat, to be the wealth creator for every Indian. Whether that happens through active funds, whether that happens through passive funds or anything.
But passive fund mein paisa kam banta hai for you as a
No, but it's about the volumes, right? I mean, the BlackRock manages $9 trillion versus anybody else who's substantially lower. So our idea is to go to everyone. At the same time, I keep repeating, we have huge conviction. Having delivered for 25 years, we have huge conviction on active funds. In fact, today I have more than what I would have 3-4 years back on the ability to generate alpha, given variety of factors. Maybe I'll take 2 minutes. It's a very favorite topic for me. I think the rise of passive, the way ESG has been getting interpreted and the way people use ESG in their portfolio construction, which is creating opportunities for other investors. I think if you interpret ESG rightly and if you implement that rightly, the rise of algo trading, program trading, and all of that, and the rise of Robinhood investors all put together are giving a lot of opportunities to active managers to generate alpha. Historically, we have always said last 20-30 years that alpha is a zero-sum game. If I'm generating alpha, then Kailash has to lose, or if Pradeep is generating, then I have to lose. Not really. All of us together can generate alpha against all these 3 or 4 things that I talked about.
Okay.
But I think there is one situation where I think, in my view, passive, recommending passive fund from a distributor point of view makes a lot of sense is when you simply want to have asset class exposure. So like if you want to invest in US market, you're happy with, just market exposure. As an investor, I would be just happy with market exposure. I'm not looking for alpha, right? In that kind of situation, I think it makes eminent sense to go with a tracker fund, a passive fund. But I would reiterate the point which, Navneet made earlier about buying ETF. One has to be very, very careful at what price you are buying. You think you are getting it cheap, but if you are buying at 3% premium, whatever, cost advantage you had has disappeared on day one. Or if you are selling at 2%, 3% discount to the NAV, whatever cost you saved in management fee has vanished. So people should understand this and look at the true cost of owning a fund. So in my view, it's very important, to have that allocation, but it's very important also for investors to get proper advice and choose what is the right thing for them. Just going for whatever is cheaper and doing it on their own, in my view, is going to land people in trouble.
Okay, that raises a very interesting point. Why should distributors look at passive funds at all, given the fact that doesn't make so much of a sense from a business point of view. The remuneration there is very, very low. In the case of ETFs, it is non-existent. In FOF and
there are respected distributors sitting here. Everybody knows that. I think if you're only looking at your commercials, then your business won't survive.
Okay.
You have to only look at what is in the interest of the client, right?
Okay.
If you do that, commercials will take care of it on its own, not the other way around.
Okay.
So you should not sell a product because commission is higher on a certain product. You should do what is right. And if you think there is a fitment of any product where commission, or let's say even for us, the same thing as I mentioned earlier. For us, I mean, if there's a right product for a certain set of investor or distributor, even if our margins are lower, but that is what we should be kind of selling.
Yeah. Kailash, yeah.
So I don't think that's a fair question at all. And the reason I'm saying that is all products are important. Okay, now if we extend that logic, nobody should be selling liquid funds at all. Because you don't earn anything in liquid funds, less than index funds or less than ETFs. But if you sell liquid funds, especially to a businessman where his money is lying in a current account and earning 0%, your ability to get far more money from that person. And today the beauty of technology is that you don't have to send a runner boy to his house to collect a check and do that. Everything happens online. So the cost of servicing such low cost products has also gone down significantly. So low cost or high cost, I think today every product is required by various individuals because there are different needs which are there. And to that extent, I don't see any reason. I just want to go back to one of the statements you said that this time we saw that passives outperformed actives in terms of the sales based on last month data. Yeah, India is a very funny market. Today, and I'm going to give a completely different example of fixed income funds. Now, today, I would love people to come into duration funds, but they are unwilling to. Now, we know that virtually the interest rate cycle has peaked. From here on, for the next 2 years, you should see either a flattish or a depreciating interest rate. But the trend will not start. When will the trend start? Historically, if I go to see after the first rate cut, you will start seeing a line of people running towards fixed income funds. The same thing happens. So if you see continuous markets perform one way, upward, we have seen flows coming in. If the markets have been volatile, there have always been cautions. What news you read is something in India we consume. So now historically over the last 20 years, we know that this is the behavior of the customer. It's not very easy to change the behavior immediately. So yes, there will be months when passives will significantly outperform active in terms of flows. But if you see 6 months of continuous positive markets without too much of volatility, you will see active funds far outperform the passives in terms of flows. So this is India, and we have to just learn to live with it.
Okay. Mukesh, when you make your internal projections for business, what do you see happening in 5 years from now? Because your fee is directly linked to the size and the growth of the passive fund category.
No, actually, to be honest, we don't look at it that way. But before coming for the conference, I was trying to do some numbers and some calculations actually. So if you look at it, last 2 years, last year incremental inflows into the industry was around 1.55 lakh crores. Before that, it was around 1.29 lakh crores. Assuming last year was an extraordinary year because target maturity funds ruled, because almost 70,000 crores money came into target maturity funds last year. Assuming on an average 1.2, 1.3 lakh crores comes in because EPF, which again is a large investor, and assuming the markets grow by, so I am assuming that fresh inflows will account for around 12 to 15% of growth, annual growth, because today the market size March end was around 6.74 lakh crores, and 9 to 10 because increase in market also increases the AUM of the fund, of the industry. So basically that will contribute 9 to 10%. Assuming industry will grow around 24 to 25%, the passive funds. So if they grow around 24, 25, because last 5 years they've grown at around 49% per year. So assuming even if they half and around 25%, logic I've given annual incremental inflows around 1.3 lakh crores plus 9 to 10% of growth. So 5 years down the line, I see my estimates would be around 20 lakh crores of AUM of the passive, which is around 6.75 in March 23, so that going up to 20 lakh crores at the end of 5 years. But still, I think because mutual fund industry will also grow, so I was just doing some rough calculations, so that will account for approximately 25 to 30% of the industry's AUM, because industry, if you look at last 5 years, mutual fund industry AUM has grown around 12-13%. So that, if it grows at the same rate, it will grow to around 80 lakh crores, and within that, around 25 to 26% will be the passive AUM. That is my estimate.
Okay.
I don't know whether Navneet.
So
what are your
for
projections?
5 years back, in equity, it was 8% of the overall AUM. And why? Because the EPFO started in August 16, and that was the bulk of the AUM. And then, of course, the CPSE and few others. Otherwise, there was not much of an AUM. So if I remember, I think 5 years back, it was around 70,000 crores. It would be like close to 4 lakh crores. And it's gone up from 8% of equity AUM to 19% of equity AUM today. On the fixed income side, it was virtually zero 5 years back, and now it's almost 13%. In fact, the fixed income AUM has not grown for 5 years. Actively managed fixed income AUM in 5 years has hardly grown. It's only the debt index fund and the debt ETFs that have grown much. So as a percentage, from zero, it has become almost now 13%. Going forward, that percentage will increase a little bit because you're starting from a smaller base, then there is that EPFO money, and of course these bond index, etc. But I think both will grow in India. As I said that in 70s when the index fund and ETFs got launched, and 80s and whatever, from there on, active has also grown. So capital fidelity is from $60-70 billion to several $1 trillion. And same is with the passive guys who've grown much more.
So in 5 years' time, what percentage of your assets do you think overall will be active in?
No, I think EPFO will remain a very, very large portion of that component. And at our end, as I said, we have the full bouquet, and investors are welcome in every kind of product. So we would like to be that fund for every reason, fund for every season.
Number बताओ ना, AUM का कितना percentage होगा?
As of now, for us, it's.
I mean, what would you?
So our total passive AUM is 25,000 crores out of, like, let's say 4.5 lakh crores.
Okay.
So that's 6-7%. Probably a percentage slightly higher than that. Yeah.
Okay. And in your case,
So we have
the combined entity, HSBC
Yeah, so
and
we have 2 index funds.
Yeah, 2 index, correct.
We are planning to launch a few more. We are
Okay.
planning to launch our ETFs. So like, very clearly, passives is required. We are too small, so I can't talk in terms of percentage terms as of now.
Sure.
But clearly, would we like to see at least 5 to 10% in the next 3 years as a part of our overall AUM in passives? The answer is yes. And here I'm excluding this, I'm talking of equity. On the fixed income side, we have again 2 products which are reasonably sized in terms of our target maturity funds. I'm not very sure, given the tax changes, how this segment will play out. But there will be requirement on passive in fixed income also. But I don't see that growing as significantly as the equity passives for us in the near future. But yes, there'll be a lot of action HSBC mutual fund in terms of new product launches on the passive side.
But globally, does HSBC believe a lot in active versus? Because there are many fund houses which have a certain view. Many of them, in fact, are active only. For example,
so we have, of course, we are largely active, but we have a decent passive portfolio globally also.
Okay.
And we have some very exciting index which we mirror globally, which can be looked at from an Indian perspective. Right now, the global products are not allowed to be sold, so we are not really talking about that. But a lot more to come from our stable.
Okay. Pradeep, you think you'll be ready in 5 years' time?
Oh, yes, certainly. It will be, of course, a business call, but I would think that, it can be 5 years, 6 years, around that time. I would think, passives would contribute probably 8 to 10% of our AUM.
So, Mukesh, when you go and meet fund houses, there are many fund houses. I'm told Franklin Templeton, Invesco are 2 of them, if my information is right, which do not believe in passive funds.
I don't think that has been our experience. In fact, last 2-3 years, almost every fund house, I will not take individual names.
Sanjay, am I right? On Franklin Templeton? No.
No, that's what I'm saying. I don't want to take individual names, but I think almost every fund house has been talking to us about launching passive products. My product team is like neck deep into work because everyone wants a new kind of an index. And just to share some numbers, if you look at last 2 years, almost 230 new products have been launched. Last 3 years, 230 new products have been launched. Out of those 230, 120 products were launched in last financial year. 121 products were launched in FY 22-23. And if you talk about the current financial year, also in the month of April is supposed to be a lean month. Already we have seen 5 passive products already been launched. So I think new products will be launched. Almost all AMCs, I think most of the AMCs, if you look at top 30 plus AMCs, are talking to us about launching various kinds of funds. So I don't say that people are talking about it. I will not take individual names, but everyone is there in the market and looking at launching funds. Yeah.
Okay. Now, I come to the last part of our discussion. Passive funds reach where active funds cannot. Okay, so they provide you access to certain segments, both in on the active side, both on the debt side and on the equity side. For example, an international debt fund. If you launch an ETF, it's relatively easy to ride on someone else's ETF and create an international debt ETF. Whereas to have the same kind of expertise in, say, active in India, that would be talent would be very difficult to get. So, what kind of possibilities do you actually see? And what are the opportunities which are yet to be tapped in the Indian market and which you urge your clients to take a serious look at?
No, I think, see, if you look at last 3 years, like target maturity, the first product was launched is Bharat Bond ETF in December 19. Before that, as Navneet said, the AUM of debt ETF was almost zero. So that was a big opportunity which was created, and now the AUM of debt funds is almost 1.9 lakh crores, almost in 2.5 years. The 3.5 years, the AUM has reached 1.9 lakh crores. So that was a good product. And so, but basically, if you look at it, international funds, which you said, because most of the international funds are passive, which is, I think, one way good for the fund houses also, because then you just invest passively into an index. You don't have to set up your entire research team and all this kind of stuff. Either they are passive or they are feeder funds. So you have basically 2 kinds of funds for the international funds. So I think in both in debt and equity, like if you look at, for us, some kind of new indices which we have launched. So if you look at bank, IT, pharma, initially, these are the sector funds which were very popular. And if you look at the composition of these indices, most of the stocks are the large caps. Now, last 1 year, if you look at, we have created indices in this segment itself, wherein we have said mid and small cap IT, mid and small cap financial services, mid and small cap consumption, mid and small cap something else. So I think we created some 4 indices. So I think those kind of new indices, new themes are being created. New index products will be launched on new themes. But one thing we need to keep in mind, basically, even though we launch new products, new indices, but majority of the AUM will continue to be garnered by the few traditional large market cap indices. Like in India today, if you look at, we have equity index funds and ETFs on 65 unique indices. But if you look at the top 6 indices, they account for 93% of the AUM. And out of the 65, there are only 17 indices on which the AUM is more than 1,000 crores. So the AUM is totally concentrated. Top 6 accounts for 93% of the AUM. So that concentration will continue. But I think people will continue to launch new products on new indices to have the entire bouquet of products available to the investors. If some investors wants to invest in a particular theme, they can choose that product and invest in that.
So there are 65 fund indexes.
No, there are 65 unique indices on which 222 passive products are available.
Oh, okay.
The AUM is
already available in India.
Yeah. 65 indices, 222 products, AUM of 4.5 lakh crores. I'm talking about equity passive. Out of which top 6 indices account for 93%. Within that, if you look at Nifty 50 accounts for 52%, Sensex accounts for 26%, and the other ones account for 6-7%. That's all. That is the breakup.
Okay. Now, another thing, Navneet, buzzwords seem to work a lot in launching ETFs. कुछ भी नया ट्रेंड आ जाता है without doing too much of a
हम नहीं
research.
करते हैं कुछ भी ऐसा नया trend
नहीं, but tell me about your
Our is
experience.
decided not by what's selling in the market. At our end, it gets decided by what our investment team believes in. Of course, we have launched a defense fund because the investment team believes in it. अच्छा वो आपने opportunity दे दी मेरे को बात करने के लिए उसकी भी.
अच्छा, ESG funds, what's your take on it?
Sorry?
What's your take on themes?
I think I really believe that ESG has to be integrated into the overall investment process rather than just using that as a sales pitch. It has to be part of your value system, your belief system, your risk management. I think you need to have a belief in it, and has to be integrated into the investment process. And I mean, a buzzword generally are like launching funds based on what's the fad of the season or what's the buzzword is neither good for the manufacturer nor for the distributor and nor for the investor. Yeah, never. I mean, if history is any guide.
Okay.
Prem, I'm going to ask you a question.
Sure.
Which is the most popular ice cream flavor in the world?
Which is the most?
Popular ice cream flavor in the world.
I guess vanilla.
That gives you the answer. You can come out with the most exotic ice creams. Yeah? Flavors, cut, this, that. Finally, vanilla will continue to rule. So that's exactly what it is. Flavors will be there. They will be there for some time. They will die out after some time. But vanilla will always rule.
Then I think every day 6 or 7 ETFs get launched globally. So that's like what? Almost 1,500, 2,000 a year.
One of the speakers earlier telling us that, the number of ETFs is higher than the number of stocks in US.
Far higher.
So,
I think in year 2000 there was 75 or 77 funds, and now there are like
more than 10,000 plus actually. More than 10,000 ETFs are there globally.
150 times from.
But again, if you look at, as Kailash said, vanilla S&P 500 rules it. They have the largest AUM, and they almost have out of 10 trillion, around 2 trillion is in S&P 500. So vanilla continues. So same thing, large caps will be there. People will keep launching different flavors to meet the requirements of few investors who want to invest in those things.
So that vanilla may be different for different people. If you give me an opportunity, I'll say HDFC Flexi Cap Fund.
Okay. So, last words for the distributors here. What would you tell them about this active and passive thing?
I would reiterate what I said earlier, that don't worry about the revenue side on the short term. If it makes sense for a client to have a certain allocation, and for many clients I think it would make sense to have certain allocation in passive funds. In distributors, I think should recommend and give good funds, nothing very complicated, nothing very exotic, just the asset class exposure. But I would recommend that for most Indian investors, that limit would be somewhere in the 10 to 20% range. So don't go overboard, but don't try to shun passive funds. I think that's a futile battle. They are there. They have a place in the portfolio, and I think we should embrace them, but not at the cost of active funds, because in Indian market for many years to come, I think active funds will generate alpha.
Mukesh, last words to the community here.
Last words, what I think this debate is on active versus passive, and we need to just keep in mind that both will continue. Distributors need to recommend to the investors based on their risk profile, based on the requirements, and the asset allocation has to be done. I think you can't look at whether I need to recommend active, whether I need to recommend passive. Just go by the asset allocation, risk profile, and their investment philosophy.
No, of course, I mean, and good that, Prem, you started by asking the question passive versus active. And if I heard you right, you said on this debate of passive and active. So finally, you also have changed that. We should end it there. Passive and active both will grow. I think in India, where, as I said, like 3.75 crore to maybe whatever, multiples of that over the next several years, a plain vanilla index fund is a very good product to get a lot of new customers into our fold. Over a period of time, as they get more convinced, I'm sure several of them would like to buy an actively managed fund as well.
Okay.
I'll just repeat what I said. Use passives, especially the traditional index funds, to get new to industry customers.
Okay, with that, does anyone in the audience have any questions? Come on, audience. मेरे को बाहर पकड़ के तो बोलते हो कि ये क्या है पैसिव फंड, क्यों कर रहे हो कॉन्फ्रेंस, और अभी सब चुप बैठे हैं. Okay, so I think you've converted them all. and they're going to be evangelists for passive funds from here on. So anyway, ladies and gentlemen, I think this panel has been very, very sporting and has really shared with us very forthright, very practical.
By the way, एक नहीं बताया आपने that एक्टिव जो पैसिव फंड है वो भी एक्टिव है, उसमें मुकेश और टीम एक्टिवली मैनेज करते हैं
वो तो है,
उसमें भी स्टॉक चेंज होते रहते हैं बाकी जो एक्टिव फंड है उसमें हम लोग एक्टिवली मैनेज करते हैं, डिफरेंस नहीं है.
Let's give a big round of applause to this lovely panel.